Robert walked away from work at 62. Over 3 decades, he had been disciplined about putting money aside. He held a traditional IRA valued at $600,000, and his plan was crystal clear. During the coming years, while his earnings were minimal and his tax bracket sat nearly untouched, he intended to shift as much as he could from his traditional IRA into a Roth. Pay the tax bill now at a favorable rate and never face it again. He had done his homework. He had gone through the articles. He grasped the concept fully. He spent 2 years making aggressive conversions, moving $180,000 over that period. He covered the taxes from a separate savings account, which meant the entire converted amount landed safely inside the Roth. His financial advisor confirmed he was handling everything correctly. Then he reached 65 and signed up for Medicare. And the letter came in from the Social Security Administration. His Medicare Part B premium was not the standard $229 per month that the majority of retirees are charged. It was $443, $10 per person each month for both of them. He and his wife were spending an additional $4,812 annually on Medicare compared to the couple living next door with identical current income. The income that caused it was not from employment. He had not held a job in 3 years. It came from the Roth conversions he had executed at age 63, 2 full years earlier. Income he had already settled taxes on. Income he believed was behind him. He did the right thing at the wrong time. And this is the story of countless retirees who are executing all the correct moves in the wrong sequence and never discover the consequences until the invoice shows up. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Timothy. Each week I break down the tax regulations, the financial pitfalls, and the strategies that shield retirees from the things nobody else is taking the time to explain. If that sounds like exactly what you need, press the subscribe button right now and enable notifications so you never miss a single video. Today, I am going to walk you through precisely why the IRS and Medicare treat age 63 differently from every other age across retirement. I am going to explain the 2-year look-back rule that almost nobody understands until it has already done its damage. I am going to show you what this actually looks like in real dollar figures using the confirmed 2026 numbers. And I'm going to hand you a clear action plan built around exactly how old you are at this very moment. Whether you are 59, 62, 63, already enrolled in Medicare, or somewhere in between, this is not a theoretical concern. This is happening to actual retirees right now this year because no one ever sat them down and walked them through how the rules fundamentally shift at 63. Most people are aware that Medicare Part B carries a monthly premium. What most people do not realize is that the premium is not uniform across the board. The amount you owe is tied to your income, and not your income today, but your income from 2 years ago. In 2026, the standard Part B premium for the majority of retirees is $229 each month. That is the baseline. If your modified adjusted gross income from 2024 came in at or below $109,000 for single filers, or $218,000 for married couples filing jointly, you pay that standard rate. But Medicare does not simply leave it there. If the income from 2 years ago pushed past those thresholds, Medicare layers an additional surcharge on top of your base premium. That surcharge carries the official name, Income-Related Monthly Adjustment Amount. Everyone refers to it as IRMAA. And here is what makes your IRMAA situation particularly dangerous. It does not rise gradually. It operates like a cliff. Exceed the threshold by a single dollar, and your entire yearly premium shoots up to the next bracket instantly. For a married couple where both partners are enrolled in Medicare, crossing into the first tier adds nearly $2,000 more per year. And it is not caused by anything you did this year. It is caused by income you had 2 years prior. Let me lay out the precise figures for 2026 so this becomes concrete and real. At the standard tier below $109,000 for single filers or $218,000 for joint filers, you pay $229 per person each month. Cross into the first IRMAA tier, ranging from $109,000 to $136,000 single, or $218,000 to $272,000 joint, and the premium climbs to 284 Roth per person per month. For a couple, that represents nearly $2,000 more per year than the standard rate. Second tier, $136,000 to $163,000 single or $272,000 to $326,000 joint. The premium becomes $365.60 per person per month. Third tier, $163,000 to $195,000 single or $326,000 to $390,000 joint. The charge rises to $447.10 per person per month. Fourth tier, $195,000 to $500,000 single or $390,000 to $750,000 joint. The premium reaches $528.60 per person per month. At the highest tier, above $500,000 single or above $750,000 joint, the premium stands at $689.90 per person per month. For a married couple sitting in the top IRMAA bracket, Medicare Part B alone runs over $6,500 per year, compared to under $5,000 for that same couple sitting below the first threshold. Identical Medicare coverage, different income from 2 years ago, and every dollar of that difference is anchored not to what you are earning today, but to a tax return that is already submitted and already in the past. It is a cliff. $1 past the threshold and you vault to the next tier immediately. The full additional annual cost applies beginning January 1st of that Medicare year. You cannot file an appeal simply because you crossed over by a modest amount from a one-time event you assumed was settled. Now, here is the rule that reshapes everything at age 63. Most people enter Medicare at 65. That is when the standard Medicare enrollment period opens. And when most retirees sign up for Part B and Part D, Medicare applies a 2-year look-back to establish their premiums. Your Medicare premium in any given year is anchored to your tax return from 2 years before. So the premium you pay in your first year of Medicare at 65 is based on your income at 63, not at 64, not at 65, at 63. That means if you are 63 right now, every income choice you make this calendar year is directly determining your Medicare premium when you first enroll at 65. The IRA withdrawal you take, the Roth conversion you execute, the stock you sell at a profit, the rental income you collect, all of it lands on a tax return that Medicare will retrieve 2 years from now and use to set what you pay for coverage every single month. If you are 62 right now, your income this year enters the look-back window for age 64. That still carries weight because your second year of Medicare premiums at 66 will be tied to your income at 64, but your first year at 65 will hinge on what you brought in at 63. If you are 61 right now, you still hold a complete planning window. Your income at 61 influences your Medicare premium at 63, which is the age when people first start worrying about the look-back. You still have the time to structure your finances properly before the clock begins. But if you are already 63 and this has not crossed your mind, the choices you make between now and December 31st of this year are among the most financially significant of your entire retirement. Allow me to be very direct about something that most financial advisors and most retirement planning publications miss completely. They zero in on tax brackets and Roth conversions without ever mentioning the specific age dimension. They tell you to convert while your income is low. That is accurate guidance. What they frequently neglect to include is that low income at 63 still carries a consequence 2 years down the road. Even if you owe zero income tax on the conversion itself, the tax cost and the Medicare cost are calculated through completely separate formulas. You can owe no income tax whatsoever on a Roth conversion and still generate thousands of dollars in extra Medicare premiums because the conversion pushed your modified adjusted gross income above the IRMAA threshold. These are two entirely distinct calculations, and almost no one walks through both of them together. Let me take you through 3 real-world scenarios so you can see the actual dollar figures and recognize your own circumstances somewhere among them. David is 63 years old. He retired at 61 from a manufacturing company in Michigan after 34 years on the job. He holds a traditional IRA valued at $420,000 and receives a modest pension that covers his basic living expenses. He knows about Roth conversions. He has been studying the concept for 2 years. His income is low. His tax bracket sits nearly empty. This year, he decides to convert $120,000 from his traditional IRA into a Roth IRA. His modified adjusted gross income for the year, including the conversion, settles at $139,000. That figure sits above the first IRMAA tier threshold of $109,000 for single filers. 2 years later, David enrolls in Medicare at 65. His standard Part B premium should be $229 per month, but because of the 2-year look-back, his actual premium is $365.60 per month. That comes to $136.60 more per month than the standard rate. Across 12 months, that is $1,139.20 more per year that David shells out for the exact same Medicare coverage. His neighbor, who had lower prior year income, pays less. Over his first 2 years on Medicare, before the look-back rolls forward to a different income year, the IRMAA surcharge costs him nearly $4,000 in additional premiums. That is money pulled directly from the Social Security check he had been counting on every single month. David's Roth conversion was likely the correct long-term move. But if he had executed that same conversion at 61 instead of 63, or if he had divided it across 2 years to remain below the IRMAA threshold, the Medicare surcharge would never have triggered. Same strategy, different timing, nearly $4,000 in savings. Sandra and her husband Thomas are both 63. Sandra still works part-time and brings in $48,000 annually from consulting. Thomas receives $22,000 per year in Social Security. They also liquidated some appreciated stock that year, shares Sandra's father had passed along to her decades earlier. The gain from that sale totaled $60,000. Between Sandra's consulting income, Thomas's Social Security, the proceeds from the stock sale, and a modest IRA distribution, Thomas took to fund a home repair. Their combined modified adjusted gross income for the year landed at $245,000 as a married couple filing jointly. Sandra and Thomas had absolutely no idea any of this would matter 2 years later. They were simply managing their household finances the way they always had. Nobody warned Sandra that selling appreciated stock at 63 would lock in her Medicare premium 2 years ahead. Nobody told Thomas that the IRA withdrawal for a home renovation would be counted. They were not making extraordinary financial moves. They were simply going about their lives. 2 years later, they enter Medicare. Their first-year Part B premium is $365.60 per person per month, and then together they are paying an extra $3,195 per year more than they would have if their income had remained below the first tier. Over the 2 years, those premiums remain in effect before the look-back advances to a newer income year. That adds up to nearly $8,000 in added Medicare costs. The painful truth is that most of the income events that triggered this outcome were things they could have timed differently. The stock sale could have been spread across 2 separate years. The IRA withdrawal could have been replaced by funds from a taxable account instead. None of these required elaborate strategies. They required knowing the rule before the financial decision was made, not after the fact. Margaret is 63 years old. She is a retired nurse from Georgia. She carries no IRA. She draws a defined benefit pension from the hospital where she worked for 27 years, and she receives Social Security. Her total combined income is $64,000 per year. She has never encountered the term IRMAA. She does not hold stocks. She has never executed a Roth conversion. She pays her bills, lives within her means, and does not worry about Medicare costs because she assumes everyone pays the same amount. When Margaret signs up for Medicare at 65, she pays the standard premium. Nothing about age 63 creates any complication in her situation, because her income at 63 remained below the threshold, and she had no sizable one-time income events. Margaret actually represents the majority of retirees. Most people living on Social Security and modest fixed incomes never approach the IRMAA threshold, and age 63 is genuinely not a pivotal year for them. But if you hold a traditional IRA, a 401k, a taxable brokerage account with appreciated positions, rental real estate, stock options from a previous employer, or any income source you can control in terms of timing or size, you are not Margaret. You are David or Sandra. And the choices you make at 63 can add thousands of dollars per year in elevated Medicare premiums across multiple years going forward. If this video is helping you grasp something your financial advisor has not walked you through, hit the like button right now. That signal tells the algorithm to surface this content for more retirees who urgently need to see it. And if you have not subscribed yet, press subscribe and tap the bell icon right now. I release videos like this every single week, and you absolutely do not want to miss what is coming up next. Here is what makes age 63 genuinely distinct from every other age across retirement. It is not only IRMAA, it is the fact that three entirely separate financial systems converge at this one age simultaneously, and each of them pulls your income in a different direction. The first system is income taxes. At 63, many retirees find themselves in what planners refer to as the gap years. They have left the workforce, but they have not yet begun Social Security or required minimum distributions. Their income has reached its lowest point in many decades. This makes 63 a compelling moment for Roth conversions, capital gains harvesting, and other income-generating tax strategies. The tax logic says generate income now because the rate is favorable and the window will not remain open. The second system is ACA health insurance subsidies. If you retire before 65 and require health coverage before Medicare activates, you are almost certainly purchasing a plan through the ACA marketplace. ACA subsidies are calculated from your modified adjusted gross income. The lower your income, the greater the financial assistance you receive toward your premiums. Before 65, a couple that carefully manages their MAGI can sometimes save anywhere from $15,000 to $25,000 per year in insurance costs, compared to someone who allows their income to run freely. The ACA logic says, keep income down because the subsidy shrinks or vanishes as income climbs. The third system is IRMAA. Your income at 63 directly sets your Medicare premium at 65. The IRMAA logic says keep income below $109,000 single or $218,000 joint to prevent the surcharge from applying at 65 and 66. The complication is that these three systems do not demand the same thing from your income at 63. Consider a real example of what this tension actually looks like. Picture a couple, both 63, who retired early. They hold $400,000 in a traditional IRA, $200,000 in a taxable brokerage account, and $100,000 in a Roth. They are purchasing health coverage through the ACA marketplace while waiting for Medicare to begin. If they hold their MAGI at $70,000, they qualify for a meaningful ACA subsidy. Their health insurance costs remain manageable, but at $70,000 of income, the Roth conversion available to them this year is modest. They have roughly $30,000 of bracket room before their income begins generating additional consequences. If they push their MAGI to $150,000 by executing a larger Roth conversion, they forfeit their ACA subsidy entirely. Their health insurance expense surges by $12,000 to $18,000 for the year, but they relocate $80,000 more into Roth. 2 years later, that conversion income surfaces in the IRMAA calculation, and they face a higher Medicare premium at 65. The near-term cost is real. The long-term benefit in reduced required minimum distributions and tax-free Roth growth might outweigh it, or it might not, depending entirely on their personal picture. There is no single correct answer that applies universally. The right answer depends on how much remains inside the IRA, how long both partners expect to live, what their tax rates will look like at 73 when RMDs begin, and what their income trajectory looks like from here forward. But here is what is non-negotiable. You cannot arrive at the right decision without recognizing that all three systems are operating simultaneously at 63. The person who navigates this correctly is not smarter or wealthier than the person who does not. They are simply the person who understood that all three rules existed before the financial decision was executed. This is precisely why generic retirement guidance, convert while your income is low, is not wrong but is dangerously incomplete at age 63. The correct answer depends entirely on your specific variables: how much sits inside your traditional IRA, what your current income is, how much your ACA coverage costs, how far away Medicare enrollment is, and what your projected income picture looks like at 65 and beyond. These variables interact in ways that simple blanket rules cannot capture. Let me walk you through the complete timeline so you can see exactly how the 2-year look-back affects each year of Medicare coverage and understand why the planning window is more specific than most people ever realize. Your Medicare premium in 2026 is based on your income in 2024. Your Medicare premium in 2027 is based on your income in 2025. Your Medicare premium in 2020 is based on your income in 2026. The pattern extends forward every single year you remain enrolled in Medicare. If you start Medicare in January of the year you turn 65, your first year premium is established by your income 2 years earlier when you were 63. Your second year premium is set by your income when you were 64. Your third year premium is rooted in your income at 65. This means the IRMAA window does not close at 63. It is perpetual. Every year you are on Medicare, your premium in the current year is being determined by decisions you made 2 years before. The reason age 63 holds unique significance is that it is the very first year that directly influences your Medicare costs. It is the starting gun. But the race continues for as long as you remain enrolled. A retiree who is 75 today and had a substantial required minimum distribution 2 years ago at 73 is paying IRMAA surcharges right now in 2026 because of income they generated back in 2024. The look back never stops. It follows you across every year of retirement. The difference is that at 63, you still hold the ability to shape your income before it occurs. By the time required minimum distributions begin at 73, the mandatory nature of those withdrawals makes managing income below the Magi threshold considerably harder. This is also why Roth conversions executed early at 60 or 61 carry such tremendous value from an IRMAA perspective. The income from those conversions is already 2 to 3 look-back cycles behind you before you ever walk through the Medicare enrollment door. The surcharges simply cannot reach back that far. And this is precisely why every serious retirement planner recommends front-loading your heaviest Roth conversions before age 63 whenever possible. Not because 63 is the sole year that matters, but because it is the first year where Medicare begins assigning your premium based on what you did with your income. Now let me address something that surfaces every time I explain IRMAA. People want to know whether they can appeal a surcharge that was triggered by income that no longer represents their current financial situation. The answer is yes, but only under very specific conditions. The Social Security Administration permits what is known as a life-changing event appeal. The form is the SSA 44. If your income has declined substantially since the look-back year in question, and that decline resulted from a qualifying life-changing event, you can formally request that Medicare substitute a more recent tax return instead. Events that qualify include retirement or a reduction in work, marriage, divorce, or annulment, the death of a spouse, loss of income-producing property due to a disaster or comparable event, loss of pension income, and employer settlement payments. What does not qualify as a life-changing event for appeal purposes is a deliberate financial choice. If you elected to execute a large Roth conversion at 63, absorb the higher premium for a year or two, and your income has since returned to normal levels, Medicare will ultimately recalibrate your premium based on the most current available tax return. No appeal is required for that. Time resolves it naturally as the look-back window advances. The appeal exists specifically for circumstances where your income dropped sharply because of something that happened to you, not something you deliberately planned. If you genuinely experienced a qualifying event, you retired, you lost a pension, your spouse passed away, and your income has dropped considerably, the SSA 44 form is absolutely worth submitting. You file it alongside documentation of the event and your current income level. The process is now available online through ssa.gov and is considerably more accessible than it once was. The approval rate for legitimate life-changing events is high, and most retirees who meet the criteria have never even heard this form exists. There is one more dimension to this that deserves its own focused moment, because it is the harshest version of the trap, and almost no one receives a warning about it in advance. When two spouses are enrolled in Medicare together and one of them passes away, the surviving partner faces an immediate and devastating shift in their calculation. While both spouses are alive and filing jointly, The IRMAA thresholds are substantially more generous. The first tier for married filing jointly begins at $218,000 in 2026. A couple can carry significant combined income and still remain below the surcharge. When one spouse passes away, the survivor must file as a single taxpayer on every future return. The single filer IRMAA threshold is only $109,000, half the married amount. The exact same income that generated no surcharge under joint filing now triggers IRMAA at the full single filer rate for the surviving spouse. This is known as the widow penalty, and it is financially devastating. A widow or widower whose combined joint income was $200,000 pays no IRMAA while married. The year following their spouse's death, they file as single on that same income, and their Medicare premium jumps instantly to the third tier. They changed nothing about their behavior. Their income did not shift. Their Medicare costs escalated dramatically simply because they are now filing alone. Let me attach a real number to this scenario. A couple filing jointly with $200,000 in income pays the standard Medicare Part B premium in 2026 because they sit below the $218,000 joint threshold. When one spouse passes away and the survivor files as single the following year, that same $200,000 of income now exceeds $163,000, which represents the single filer boundary for the third IRMAA tier. The surviving spouse's monthly Part B premium jumps from $229 to $447.10. That translates to an increase of over $2,600 per year from the identical income, simply because they are now navigating life alone. Roth conversions completed before this scenario unfolds are one of the most powerful defenses against the widow penalty. If the couple moves substantial IRA assets into Roth before one spouse passes, the surviving partner can draw on those tax-free Roth accounts in the years that follow. This holds their modified adjusted gross income lower as a single filer and helps them remain at or near the IRMAA threshold. This is yet another reason why age 63, when most couples are still together and still filing jointly, represents such a vital window for Roth conversion planning. You have the advantage of the higher joint threshold working for you right now. The day that advantage disappears, you may have no path to reclaim it. Here is your action checklist, what you need to do based precisely on where you stand right now. If you are 60 or 61 right now, you are inside the cleanest conversion window you will have available. Your income at these ages does not fall within the IRMAA look-back for your first years of Medicare. You carry the greatest flexibility for Roth conversions at this moment. Deploy it with intention. Model how much you can convert each year while remaining inside a tax bracket you are comfortable with, and convert as aggressively as you are prepared to over the next 2 to 3 years. Every dollar you shift to Roth now is a dollar that will never appear in an IRMAA calculation for the years immediately following your Medicare enrollment. If you are 62 right now, you are 1 year away from the first IRMAA critical year. Your income this year establishes your Medicare premium at 64, your second year of enrollment. It remains a productive conversion year, but you should begin modeling exactly where your MAGI threshold stands and what your anticipated income will look like at 63. The 2 years of 62 and 63 together form your opening IRMAA window, and they call for a coordinated plan rather than independent decisions made 1 year at a time without regard for what follows. If you are 63 right now, pause and complete this step before making any income decision for the remainder of the year. Pull up your most recent tax return and locate your modified adjusted gross income on line 11 of your Form 1040. Now determine where you stand relative to the threshold for your filing status. For single filers in 2026, that number is $109,000. For married filing jointly, it is $218,000.